Hello everyone, welcome to Mastermind. Today let us learn more concepts about economy by solving few more multiple choice questions. These are very important questions. Please try to solve these questions before watching the video for solutions. Now let us get started. First question says, which of the following does not come under money market? Commercial paper, debentures, certificate of deposit, treasury bills. Here the right option is option 2, debentures. First of all, let us see what are money markets and capital markets. So we have to see what are money markets and capital markets. Money markets are markets for short-term funds. Please remember, short-term funds, whereas capital market is an institutional arrangement for borrowing medium and long-term funds. Medium and long term. Please remember, money market is for short-term funds, while capital market is for medium and long-term funds. Money market deals in financial assets whose period of maturity is up to 1 year. Very important. Please remember this. It should be noted that money market does not deal in cash or money as such. So it does not usually deal in cash or money as such, but it simply provides a market for credit instruments. Very important. Credit instruments such as bills of exchange, bills of exchange, promissory notes, promissory notes. Please remember, promissory notes, commercial papers, certificates of deposits, and treasury bills. Therefore, commercial paper, certificate of deposits, and treasury bills all come under money market, whereas capital market is the institutional arrangement for borrowing medium and long-term funds and provides facilities for marketing and trading of securities. It provides the platform for trading and marketing securities. So it constitutes all long-term borrowings from banks, financial institutions, borrowings from foreign markets, and raising of capital by issue of various securities. So which are these securities? Shares, debentures, bonds, shares, debentures, bonds, etc. So capital market is that market where shares, bonds, debentures are marketed and they are traded. Consider the second question now. The role of the capital market include mobilization of savings, acceleration of capital formation, promotion of industrial growth, raising of long-term capital, regulation of funds. So here the right option is option 4, A, B, C, D and E. So let us see what is capital market. As we have already seen in the previous question, capital market is the market where instruments like bonds, equities, and then mortgages, etc. are traded. It is a market which deals with long-term funds, long-term loans. The capital markets are mainly of two types. The first one is the primary market. And the second is the secondary market. So in a primary market, companies, governments or public sector institutions can raise funds through issuing bonds afresh. So corporations sell these companies like governments, major companies, etc. They can sell their new stock. Through initial public offering and raise money through that. What is the initial public offering? Initial public offering forms the first set of shares that are open to public. So this is called as initial public offering, and these are directly sold to customers by the company. In the secondary market, the stocks and shares and bonds are bought and sold by the customers. So in the secondary markets, the ones that are purchased are traded. So in other words, it's very easy to understand. Primary market is the market where securities are created, where here bonds, shares, equities are created, while secondary market is those securities that get traded. So in the primary market, securities get created. In the secondary market, the securities get traded. In the primary market, companies sell new stocks and bonds to the public for the first time. They sell it for the first time, such as initial public offering. In the secondary market, these stocks that are acquired are traded. Majorly, they are traded here. So this forms capital market, primary market and secondary market. Now, what is the significance of capital market? It is highly significant in the economic development of a country because what happens is it mobilizes the savings. Secondly, acceleration of capital formation. Companies can create capital for themselves by issuing shares, raising long-term capital. As we have seen, the capital market usually deals with long-term capital. Therefore, the companies can raise long-term capital, that is capital that can be used or that is in the market for more than 1 year. Promotion of industrial growth. With this, when the companies sell their shares and make money, it promotes the industrial growth. Technical assistance. So it also provides technical assistance with the amount what the companies have procured from the capital market. They can go for technological advancement or technical advancement. Proper channelization of funds. Whatever the fund that is in the economy can be channelized towards the development of the nation, as these funds now come to the hands of the companies which they use for job creation. Secondly, development of backward areas, accumulation of foreign capital. So even foreign investors can invest in the domestic market through shares, debentures, equity, etc. And also promote easy liquidity. Those amount which goes to bank and those will be redundant in bank will flow in the economy through capital market. Third question says Reserve Bank of India can impose restrictions on withdrawals of any bank when bank is facing economic crisis. The RBI can impose restrictions under RBI Act 1934, Payment and Settlement Systems Act 2007, Fiscal Responsibility and Budget Management Act 2003, Banking Regulation Act 1949. So here the right option is option 4, Banking Regulation Act 1949. Recently, Reserve Bank of India had slapped restrictions on withdrawal of Punjab and Maharashtra Cooperative Bank Limited, known as PMC Bank. RBI can impose such restrictions under the Banking Regulation Act 1949. So RBI Act 1934 is the act through which RBI got established. Payment and Settlement Systems Act 2007 is not related with this particular restrictions that RBI imposes on banks. The restrictions on withdrawal on Punjab and Maharashtra Cooperative Bank Limited was in the news recently. That's why this question has come up. Fourth question says, consider the following statements regarding economic sanctions. A sanction is a penalty levied on another country or on individual citizens of another country. It is an instrument of foreign policy and economic pressure to deal with international trade and politics. Here, the right option is option 3, both A and B. Both the statements are correct here. What are economic sanctions? Economic sanctions are nothing but penalties. These are nothing but penalties or bans that are levied against a country to push it to modify its strategic decisions. Recently, Russia faced this economic sanction as Russia invaded Ukraine. As Russia invaded Ukraine, most of the Western countries imposed sanctions on Russia. So, what are these economic sanctions? These are penalties or bans that are levied against the country. In this case, it is Russia to push it to modify its strategic decisions. Here, the strategic decision is to stop invading Ukraine. They include, so what are these sanctions? What are they include? They include withdrawal of customary trade. The most of the companies they sever or cut the customary trade ties and financial relations. So trade and financial relations are usually severed for security and foreign policy purposes. In today's foreign policy, trade sanctions are used prominently. It should also be noted that after the Pokhran nuclear test, that is the Operation Smiling Buddha, done by India, even India had faced economic sanctions. India had also faced economic sanctions in the aftermath of Pokhran test. Fifth question says, consider the following statements regarding initial public offering. An initial public offering refers to the process of offering shares of a private corporation to the public in a new stock issuance. A company intending to issue shares through IPOs first registers with SEBI. Both the statements are correct here. Therefore, the right option is option 3, both A and B. I have already told you that initial public offering usually happens or it naturally happens in primary markets. So what are primary markets? Primary markets are the markets where securities get created. So initial public offering refers to the process of offering shares of a private corporation to the public in a new stock issuance. Let us say there is a company called ABC. This is a company called ABC, and it has never issued its share to the public. Now, if at all this company wants to issue shares to the public, then it has to register itself with SEBI. What is SEBI? SEBI is nothing but Securities and Exchange Board of India. So what happens here is once the company ABC gets registered with SEBI, then it will have the right to issue shares. A company intending to issue shares through IPOs first registers with Securities and Exchange Board of India. So IPOs provide opportunities to the company to obtain capital by offering shares through the primary markets. So where all these things once the securities are acquired, then they get traded. The securities are traded in stock exchanges. So stock exchange is an organized market for the sale and purchase of securities such as shares, stocks, bonds, etc. So this is all about economic concepts in this video. Please note down these points as these points will be handy before examination. Thank you.